This is Financial Myth-Busting with Don Bennett, where politics and the economy intersect.
And Chris Casey is here. Casey is the managing director of WindRock Management, where he advises clients in today's world of significant economic and financial intervention. He's also a frequent speaker before a number of organizations and conferences, including USA Watchdog, Gold Money, and Freedom Fest. As well as his writing has appeared in a variety of publications such as The Family Business, Casey Research, and the Ludwig von Mises Institute. Now, Chris is here today to help us better understand, I would call, an epic event that happened this past week. And not too many places, I think, are talking about it, where China sold somewhere in the order of $100 billion in long-term U.S. Treasuries, again, in the past 2 weeks, which is where I want to start today. Chris, welcome to Financial Myth-Busting.
Right. Well, thanks for having me on, Don.
So how epic is China's selling of approximately $100 billion in Treasuries? How epic actually is this to the Federal Reserve? Do you think it registered with them?
I would hope so. I think it's huge, and not just what they're doing with Treasuries, but their interventions overall as far as devaluing the currency and what they're trying to do to prop up their markets. I mean, what we're looking at is amazing that Greece got so much attention over the last several months, and really that's a drop in the bucket compared to how important China is to the world as well as the United States.
So, maybe the bigger question is now, how much more does China have left to sell? I mean, we saw the impact that it made last week. How much more do they have left to sell?
Well, they have plenty. I mean, their foreign currency reserves in general are about $3.7 trillion, and I think of that about $1.2 trillion are U.S. Treasuries and similar assets. So they have quite a bit. I mean, what I really find disturbing is not so much that the Chinese market has gone down so much over the last several months. I mean, it's off maybe 40% from its peak this year. But the government's interaction is not just that they're trying to prop up these markets by selling assets and using those funds, but also just their draconian measures in general as far as trading and the elimination of true price discovery in those markets.
So what happens when China liquidates all of its Treasury holdings? Or maybe, again, the next question is, what about if other countries decide to join China as it sells U.S. Treasuries? Long maturity, short maturity, medium maturity. I mean, we've never really seen this kind of pace before, so I'm just wondering if that could happen.
We haven't, and I think it can happen, and what's disturbing is the complacency in the financial markets about this. I mean, right now, as you mentioned, there's rumors that there's around $100 billion that's been sold in Treasuries by China since its devaluation. I think last week alone, or last several days, there was about $15 billion they expected. And so what that means is that it could spike interest rates. And right now, no one's concerned about that because the 10-year Treasury hasn't moved. But really, you can never look at economic analysis as to what's going on but for what would have been done. And what would have been done is that we would have expected Treasuries to go down quite a bit as far as the yields based on a safe haven effect over the turmoil and the volatility. And so what we haven't seen is that happen. And I think the reason behind that is really because of China selling the Treasuries. And so what you have is, while you have increasing demand for U.S. Treasuries due to volatility, now you have increasing supply of Treasuries due to China, and they've kind of canceled out, and that's why the 10-year U.S. Treasury has been bouncing just north of 2% for the last couple of weeks.
Let me ask you, do you think China's FX management means that Beijing has joined the global U.S. dollar asset liquidation party, again, to unwind the petrodollar system?
I think they've made up their minds on that for some time. I mean, it's been clear from their agreements with Russia, from what they're doing with starting essentially their own bank, World Bank across a number of developing countries. I mean, they've been very deliberate in these steps to bring down the U.S. as it's the primary reserve currency throughout the world. And they clearly want their own currency to do that. Now, what they've done recently, I think, really hurts their cause by devaluing the yuan, by these government interventions in the marketplace. I mean, they've basically telegraphed that, hey, we're just like any other government, and we don't mind not having a stable currency. And so in some ways, their long-term plans have been at least briefly interrupted, but I think clearly long-term there's a deliberate plan to bring down the U.S. as the world's reserve currency.
It seemed everyone blamed China for the last couple of weeks in the market. And I'm wondering, how much do you blame China for the sell-off we've had in the U.S. market? Or do you think this was just a pent-up correction that was just looking for an excuse?
At WindRock, we talk about this all the time because the U.S. markets, are so overvalued and have been so overvalued for some time. We've often thought that really on any news, you could easily see a 10% correction, 10% blow off from their highs. I mean, because this market is as overvalued as it's been in 1929 or 2001 or 2000 or 2007. So you can easily see that happening. But I really think this is caused by China. I don't think its magnitude is truly being understood and expressed within the markets. But I think people are they have an inkling that something's awry. And so I do think China is a legitimate cause. I don't think it's been fully appreciated. So I think U.S. markets could be far more affected. And, you mentioned earlier about Treasuries and the impact. If China continues down this road, what we have is interest rates that are 2%. Obviously, we're at historic lows. But if we just went to a normal, say, a 3% historic rate over the last 30 years, if we went to 8%, which we saw in the early 1980s, that U.S. debt right now at, I think it's $18.2 trillion, we go from being simply insolvent, which U.S. clearly is by any metric,
right,
to being illiquid. And that means you can't service that debt. And so if interest rates spike, if they get out of hand, I mean, that's a real danger for the U.S. government.
So you're saying that the China's U.S. Treasury liquidation, this frenzy, if they continue it at this pace, can no longer be swept under the rug, and that we do have consequences, and it's going to be pressure building on the U.S. Treasury yields and moving them up. Is that correct?
I absolutely agree with that. And in long term, that's going to happen no matter what, but this can certainly serve as a catalyst in the short term for that happening.
But, again, I think for our listeners, when something like that happens, it could choke off the U.S. housing market, right?
Absolutely.
I mean, there's other fallout that happens with this when interest rates go up like that, and the Fed really won't have much control over that.
No, they won't. And you're right. There's fallout everywhere because interest rates are the key price in the free market for everything, right? It governs long-term planning, and it governs consumption versus savings. I mean, it's really an expression of that, but to the extent it's manipulated, it changes those patterns. And so, right, the interest rates are going to have long-term significant repercussions in every market, the stock market, obviously the bond market, but in the housing market. Everywhere you look, it's going to be affected for investors.
To put it mildly, this past week, last week, 2 weeks ago, it was wild, but I think this past week was extra wild on Wall Street. And we had that 1,000-point free fall on Monday. And then all of a sudden, what I call the plunge protection team jumped in and regained about 400 points so quickly. I guess my question to you is, what do you attribute the midday bounce to? I think it's the plunge protection team, but I'm wondering what you think it is.
I have no doubt that U.S. is like any other government that routinely and systematically intervenes in financial markets for their own purpose. I don't doubt that. What I do question is maybe the effectiveness of it.
Right.
And so I don't know if that's necessarily the cause. I think what's more likely, two things help the market over the course of the week. I'm not sure about intraday any particular time, but to put it in perspective, by the way, I think intraday on Tuesday we were down about 12% from the market's high. So significant, and that's coming from a 6% decline the previous week. And as you mentioned, it was volatile, right, where the Dow was up 1% for this entire week. But
right.
I think the two things that are perhaps going on is, one is that we saw the Fed take out their exact same playbook back in October of 2014. So back then you had James Bullard came on and said, hey, the Fed's going to start potentially easing through the stock market correction. By the way, the markets should have nothing to do with the Federal Reserve, right? That's not part of their mandate. Nowhere does it say they have to prop up equity markets.
That's right.
But not only did he did that back in October of 2014. We saw that happen, I think it was Wednesday of this week.
Yep.
Now we had New York Fed Dudley say, hey, he finds it less compelling, the arguments for an interest rate hike this month or even later this year. And so the Fed, number one, the Fed goes right back to their same playbook and starts jawboning the markets up. So that's one factor. The second was that China continued their intervention to prop up their markets later that week. And although their markets were off significantly during the week, they were up, I think, about 6% the last 2 days. So I think after the Fed came in and tried to talk the markets up, you had China do some things that the markets interpreted as beneficial, even though they're not. And therefore, the markets, the Dow was up 1% for the entire week.
I wonder how long our central bank, the Federal Reserve, will actually remain meaningful. I mean, I think the central bank stimulus, quantitative easing, plunge protection team activity, I think as a social policy has been discredited because the economy is not strong. People understand that. And I also think it means that in 2008 and 2009, the fixes that were available back then to them, they're just not effective anymore. So how long do you think they can keep this up?
I do think that people are starting to realize. In fact, the Federal Reserve admitted in a paper recently that QE was a disaster and hasn't done anything to help the economy. And by the way, I don't think we should even call it quantitative easing. It really should be called qualitative easing because all you're doing is diminishing the value of the U.S. dollar. They're not completely out of bullets. I wouldn't be surprised that if they continue to increase the money supply at an accelerated pace sometime in the future. I don't think they're going to call it another QE program, though. I mean, that sounds ridiculous, although...
But it's going to be the same thing.
Right. I have no doubt they have a team working on a new name and somehow a new cover. But
a new marketing team.
A whole marketing team, right? I mean, the same team that came up with QE in the first place. But I wouldn't be surprised if they do some other things. I mean, they could adjust reserve requirements. And this is one of three mechanisms by which the Fed can increase the money supply, which hasn't been done in a long time, so people don't talk about it. But China did it last week, so right. I wouldn't be surprised if the Fed did it. And on top of that, I wouldn't be surprised, we have this issue of the excess reserves, and they're still paying money to banks on excess reserves. I wouldn't be surprised if they eliminated that. I mean, it was supposed to be a temporary measure back in 2009 or 2008. I mean, so why not eliminate that as well and try to push money out into the economy? I think those two things are the most likely courses of action for the Fed in the most immediate future.
Some are projecting now that, contrary to the path stated by Janet Yellen, that interest rates are actually going to be raised next month. As the economy improves. I mean, they came out with a very glorious GDP number, which I'm not really certain where they got it from this week. But do you actually agree that that interest rates are actually going to be raised?
Well, they certainly have painted themselves in a corner.
Yep.
And I think the only entity or economic actor out there that doesn't want rates raised more than the market or investors and everyone else out there is the Fed itself. Mm-hmm. I mean, that's the last thing they want to do. They will grasp at any straws. They will look at any supposed data that will help them to delay that. Now, if they come to the conclusion that they have to do it no matter what, let's put it in perspective. It's a tiny, tiny nominal increase, right? It's 25 basis points, so it's not a big deal. But on top of that, really what could happen is that while they do that, they could do something else to counteract that effect. So I wouldn't be surprised if they, at the same time, they increase rates. They're doing something else that would more than offset those so-called tightening actions. So
right.
look for some other actions by the Fed at the same time.
Our Federal Reserve's constant injection of what I call fiat fantasy fuel since the 2008-2009 crisis began, it's covering up something, collapsing demand, not just domestically but worldwide. But with that comes collapsing sales and collapsing market value. How long do they think they can cover this up? I mean, this what I would call stock buyback scam that went on even last week in the market.
Well, I suspect they've covered it up longer than they had expected to, because they were hoping the economy would have recovered more at this point. I mean, mm-hmm. this is a long so-called recovery that's not a real recovery, right? So I think they expected things to turn around. I think they're a little shocked that things haven't blown up in their face so far. So I think they'll continue to do it until they see real signs that things are moving against them, until they see some significant inflation that shows up in official statistics or something to that effect. They'll keep doing what they do.
So in the murky world of market fantasy, we should just assume that the Fed is going to continue to do what they've been doing, i.e. protect the investor against any bad decision. I mean, essentially, you can't go wrong if you're in one of the main indices. Oh,
I think that's their mentality. However, I do think they're going to lose control of this fairly quickly, and there's only so much they can do. They will fight tooth and nail and try to increase the money supply. They'll go right back to their same playbook, right? There'll be bailouts. There'll be huge deficits in the next recession. There'll be massive money printing in some fashion. But ultimately, they cannot ignore economic reality forever. They're going to lose.
Chris, we've got about 45 seconds left for the first segment, but I want you to start thinking about something when we get back. I'm wondering, where do you forecast China going from here? As well as, honestly, I want to keep hitting this subject about them liquidating their treasuries. If they continue to go at this pace, I think we only have 18 weeks left, but that's going to be a damaging 18 weeks for us. I think you would agree, but I want to talk a little bit more about that. So stay tuned, everybody. When we get back, we're going to dig deeper, and, we'll be back. And this is Dawn Bennett with Chris Casey. And Chris, before we went to break, I said, I want to come back, revisit the China question. I mean, where we go from here with China is an open question. But to me, it's clear that that this relationship between the China FX reserve drawdowns in defense of their currency, the yuan, and again, the dramatic decrease in petrodollar flow, just seems to be this self-feeding loop that, that sustained the dollar in the past, and it's propped it up in the past, and now that's broken. So I'm wondering, what do you think the consequences are going to be if they continue to do these drawdowns to sell the U.S. Treasuries?
Oh, extremely negative. And, that's one item I didn't mention earlier, but which is directly on point you just mentioned, was also oil. To the extent that the U.S. continues to be a major powerhouse as far as oil production, all that means is that you have lower oil imports going forward. Combine that with a lower oil price, and suddenly that current account deficit starts shrinking or will shrink over time. And if that happens, the only way to offset this current account trade deficit that U.S. has historically run is for foreigners then to take those dollars and to buy capital goods, meaning treasuries. And so at the same time, if you have a declining demand from China to buy treasuries, if they actually become a seller in a long-term scenario, and if you have the oil price and oil production in the U.S. causing greater need or demand from foreigners to buy U.S. treasuries, that's a double whammy with significant repercussions. And so, put it in perspective, if interest rates here in the U.S., because they negatively affect the greatest debtor, which is the U.S. government by far, and if we have debt payments that move to, let's say it's like 8%, which we saw in the early 80s, it's not unheard of. If that happens, look at what happens to U.S. government budget. Right now, we take in maybe just over $3 trillion in tax revenues. If you have interest rates go to 8%, you're going to eat up 60% of those tax revenues on interest payments alone. So what we're talking about is not just a massive repercussions to U.S. economy, but massive repercussions to U.S. government itself in becoming extremely illiquid in addition to insolvent.
Because of that, do you see a second kind of 1,000-point market crash imminent in the U.S. markets?
That's certainly possible. I think that what we're looking at now is the first shot in a long-term bear market. Mm-hmm. And I think 2 years from now, if we look back, we will say that, hey, what happened after China's actions was really the start of the end. And I truly believe that. I mean, it's not just a matter of what China's doing. It's a matter of how overpriced U.S. markets are. It's a matter of how fragile the U.S. economy is. I mean, I could see easily us slipping into another recession. But unlike 2008, this may be a recession that also has inflation. So it's a double whammy to U.S. Consumers and U.S. citizens.
So in other words, the rebound that we felt last week in the markets, it's more of an eye of the hurricane, right? Because actually the negativity can return in full force.
I agree. And I think it may be a long way from a serious downturn, or maybe 6 months from now, but I really think this is the first crack in that dam, and things are going to really overwhelm policymakers going forward.
Very quickly, we've got 2 minutes left. I know that you see a parallel between what's happening in China today with the American economy, economic situation that happened in the 1920s. Can you explain that? And does that mean China's headed for a Great Depression, or is it us?
Well, China could be headed for a Great Depression. I mean, the comparison, I think, is valid because in the 1920s, they're called the Roaring '20s for good reason, right? We had amazing economic growth, real growth that was going on. Now, at the same time, based on what the Federal Reserve was doing in the aftermath of World War I, they were expanding the money supply, which created extensive malinvestment throughout the economy. And so that culminated ultimately in the Great Depression. And we see the exact same thing going on with China right now. we are experiencing in China a rare moment in history where there's tremendous real growth. It's akin to 19th century America, post-World War II Japan. But at the same time, there's tremendous malinvestment. I mean, there's the ghost cities, ghost malls, ghost apartment buildings, ghost airports. You have more concrete consumed in 3 years in, I think, 2011, 2013 than the U.S. consumed in the last century. So there's massive malinvestment that's running side by side real economic growth. So it can absolutely end up as a depression. What kind of depression depends on the actions the U.S. or the Chinese government takes.
And do you think they have the ability to sidestep the possibility of depression?
They do have the ability. However, let's put it in context. Since 1978, when Deng Xiaoping implemented these economic reforms, they've had tremendous growth, and the Chinese government has always been hands-off, except when they've been challenged with civil unrest.
Right.
I think what we're looking at now, and by the way, they're operating under this concept of the mandate from heaven. There's a great book called The New Emperors by Harrison Salisbury that talks about this. That's the only time when they really intervene is when they feel that their authority, their mandate from heaven is threatened. And I think right now what they're looking at is an economy that's